Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel L. Connon, along with Brianna Valesky, and we have Douglas Cote on the line. He's Chief Market Strategist at Voya Investment Management. Douglas, how you doing this morning?
I'm doing fantastic. How about you?
Good. Thanks for joining us on the show. It's always good to get a larger, bigger macro perspective on the markets. Can you just tell us a little bit about your firm, Voya Investment Management?
Voya Investment Management is a retirement investment insurance organization. We have the investment side. We have about $215 billion under management, and that's about it.
Okay. I got to ask you about the term that you coined, honest EPS, as a way of identifying high quality stocks. How did you come up with that term, and tell us the components that make it up?
Well, back in the bear market, all the way back in 2001, what I was noticing is, and I was an equity portfolio manager back then, and what I noticed is a lot of companies reporting corporate earnings were reporting one set of numbers to the SEC called GAAP, generally accepted accounting principles, and another to the street, to Wall Street, saying this is what our numbers are. And some companies were very, very different. It seemed like they were trying to pad their numbers, and they were writing off everything but the kitchen sink to make them look good, and much lower numbers to the SEC. And I said, well, how does Wall Street accept that? And could I use it to my client's advantage by saying, let's just focus on the companies that are really honest, and the numbers they send to the SEC on their earnings is the same as they report to the street. And it's amazing that it still goes on. There's still a big difference. So you have to actually look at the press release, and they say, after extraordinary items, and after this, and after this, that's what they report to the street, and it's a padded number many times.
Overall, I mean, I know we can't talk about individual stocks, but would you say the majority of companies, listed companies on Wall Street, go with the honest EPS? Do you feel it's half and half, or you think it's slated the other way?
No, it's really, I would call it's in the tails of the distribution. So there's extremely honest companies. There's companies that are kind of in the middle. It's close enough, but then in the extremes, and probably a smaller percentage, and it's usually during bear markets and recessions that it gets a bigger number. So it's the exception rather than the rule. So if it's the exception, why not avoid those companies that are really trying to, I think, engage in chicanery to Wall Street and to investors.
Moving on, retail sales Thursday here. Boy, Macy's taking on the chin yesterday, and Kohl's today. We have JW Nordstrom coming up. We got school season, school shopping coming up. Any takes on the retail sector?
I think we're going to have a strong back-to-school retail sales season. Actually, retail sales were better than expected this morning. It was 0.6 versus 0.4. That might not seem like a lot, but it is directionally. The magnitude is strong. But also, you have to look at the numbers. There was a revision last month. So last month was minus 0.3. They revised that up to flat. So it looks like retail sales are actually much better than expected. And we think that continues because with oil prices, energy prices, continuing to give a dividend to consumers with continued low prices, there was some concern that the drop in oil at the gas pump was going to come right back up. It hasn't. And we expect, we call that the energy revolution, a tectonic shift that is likely to keep oil low and gas prices low for the next 20 years, benefiting continued strength in retail sales and for the consumer.
Okay, so this kind of, relates to the commodity bust here. I mean, oil here bearing down on the low of the move. Gold got a little bit of a pop. I know some of the grains got hit yesterday. I mean, with all this deflationary trends that are coming out here, how in the heck is the Fed going to raise rates in September?
Well, certainly there's two sides of the Fed mandate. There's employment, and then there's inflation. Certainly, with we call it the bust in the commodity super cycle, that's over. That is deflationary and will keep inflation low. So it gives the Fed wiggle room. But with employment down 5.3%, and we expect continued strong numbers. If you look at initial unemployment claims that actually came out today, it continues to be under 300,000. So it bodes well that we could be at 5.2 or 5.1% in the September meeting or even through December. So it's really 50-50 whether the Fed raises in September, but certainly they're going to raise in 2015. If not at the September meeting, the December meeting. But as you said, commodities and with all that's going on in China, is definitely deflationary. So it gives the Fed wiggle room.
Okay, moving over here, that you mentioned China there, and that like yesterday or 2 days ago, they devalued the yuan, and chaos in the markets. It was kind of delayed reaction. We had the kind of the muted reaction on Tuesday. Yesterday we had the big sell-off, and then the rebound. I mean, there's a lot of things going over there that could really be very concerning and have implications for our markets. This is something that you pay attention to. Are you doing any investing over there? What's your appraisal of the situation in China?
Sure. First, you have to draw a distinction between developed markets, which have been very resilient with strong fundamentals, and emerging markets that continue to struggle. And China is a good example of why we're not as concerned with the Fed a 25 basis point move, because the most telegraphed piece of data over the past year, a few months. Then you get a surprise like China devaluing consecutive days. What happened yesterday, first of all, it was a big surprise, and markets do not like surprises. And why is China devaluing their currency, the yuan? And there's concern that maybe they're going through a hard landing. I think what they're doing is using every tool at their disposal to help their economy. Certainly their economy is slowing. What happened yesterday, there was a big sell-off because 2 days in a row, the China Central Bank devalued, and then they came out with language later saying, well, they're not going to continue to devalue, and the market got a grip on it and said, well, maybe this is not a disaster, and maybe this is just a couple adjustments to get back to normal. So I think now the market looks at Europe's up today. The U.S. futures were up earlier. So I think the market's now looking past this. But it's certainly on our radar, and we're certainly paying attention to the second largest economy in the world.
Yeah, you certainly have to. Well, here we are. We're really within shouting distance of the all-time highs. I mean, we talked about the longest losing streak in 4 years, going back a week or so. We're still near all-time highs here. Are there any sectors here that maybe catching your attention that even if the market does pull back, that these sectors could still perform pretty well?
Well, I'm a multi-asset class specialist, and what I look for is, with the potential, and certainly the Fed is going to start raising rates. If you want to add a floating rate note to your portfolio, that's a senior loan bond that actually will ultimately adjust to rising rates. We still like in the equity, we like large cap growth, we like U.S. mid caps, and we think global REITs are a good hedge in the long term and a good negative correlation asset class.
Could you what was that term you used? Floating. What was that term you used?
Yeah, it's floating rate note. It's a senior loan. It's senior loan that is essentially a bond that gets reset every quarter depending on where rates are. And I want to be clear, there's rates will have to move up about 1% to exceed the LIBOR floor before they start adjusting the coupon. But these are loans in bonds that are one of the best performing fixed income instruments this year, and we think it's a very attractive place to be.
Is there any ETFs, or do you just have to go to the individual companies to in order to participate in those?
Well, at Voya, we certainly have a product that does that, and but there are ETFs that have floating rate instruments in them.
I mean, I think there's there's a concern about rates and of course the increase. I mean, do you think you're going to see a series of increases? Do you think they're going to do one just to get it out of the way because they said they're going to? Or do you think this would be, sustained? Because we are, you talk about the recovery in our country and I don't know. I mean, yeah, you're getting the unemployment rate down. Many people discuss whether the participation rate's going down. I mean, you're having a lot of, higher paying jobs from the oil service sector being, replaced by lower paying jobs here. I guess people aren't that concerned with rates going up, but it's the rate of, the pace of the decreases. What are you looking at?
Joe, you make a good point. It's all about the pace of the increase, and I think investors are over anticipating a strong increase in rates, and that's not the case. It's going to be very shallow, very measured by the Fed, and what you'll see is the bonds will not have as big an impact as investors are really fearful of. And we still like bonds because of that. We like spread product, corporate bonds, high yield bonds, as well as the floating rates that I discussed. And we think it's going to be a very slow increase. And Janet Yellen, the Fed chair, even said that we want to get started earlier so we can keep it at a very shallow, measured pace. So investors need to keep bonds in their portfolio and not panic. And there's been some serious outflow of bonds, and in that period of time, bonds prices have actually strengthened with the uncertainty of China. So we think bonds are a good risk control asset class. With the surprises that we see geopolitically, you want to keep them in your portfolio.
Just, kind of looking in the rear view mirror here, Greece, I mean, I guess for all intents and purposes, it's been resolved here. I mean, you think this was just an excellent job of just kicking the can down the road, and in a year or two we're going to be revisiting the situation, or do you think they got things under control this time?
Well, what we were advising clients earlier in the summer is look past Greece. There's 0.2% of the entire Eurozone. If need be, the ECB and IMF really could write a check and be done with it. But the third bailout looks like it's going to be agreed to by tomorrow. And we said there basically as much ado about Greece. Don't worry about it. Look past it. That seemed to be, you barely hear Greece in the media anymore. And that's what we were counseling, that this is not a big deal. It's a very small country, and its impact is small. And so the other thing that we find is the adage is markets climb a wall of worry, and that's exactly what's been happening.
Yeah, it's just something for, the media to cover and make a big deal about, kind of like the Ebola crisis. Douglas, any final words of advice for investors here? You got 26 years of experience. You've dealt with a lot of different clients. You've managed a lot of money. Just any final words of advice?
Broad global diversification. Don't put all your eggs in one basket. Spread your risk out. There's still opportunities despite the uncertainty in the emerging markets and around the world. Global growth is expected to be about 3.3% this year. And so be global.
Okay, Douglas Cody, Chief Market Strategist at Voya Investment Management. Give us a great perspective on the markets. We'd love to hear the macros, and like your term, honest EPS. I'm going to be looking for stocks that have that. Have a good day.
Thank you, Joe.
Yeah, we'll talk to you again soon.
You too.